There's the closing bell on Wall Street, and now it's market domination overtime. Jared Blikre is going to be along in a moment to give us the details from today's session. But I'm going to start with the major averages here. And it looks like things are taking a little bit of a leg lower as we close out today's session, this Monday session. The Dow now down about a point, little changed on the day here. After starting the day in the red, it's kind of made a round trip here. Not necessarily any specific headlines in the last hour that necessarily would have sent things in this direction, but we're seeing it for all three major averages. The S&P 500 also heading back to the unchanged line. The Nasdaq hanging on to a gain of 1/3%, and it is the least sort of, even though we see some intraday volatility here, sort of the most stable by comparison between positive and negative during the session. In terms of the trade headlines that we continue to watch out of the U.S.-China talks happening in the U.K., it looks like they have concluded for the evening, and Treasury Secretary Bessent was quoted as saying that things are going relatively well so far. That said, not seeing any big enthusiasm today. Jared's got a closer look at the action. Hey, Jared.
Yes, not a lot of big movement in the majors today, although I will pull up the S&P 600, which is the small caps. This is a two-day look. We've had decent pops both days, and the result is up 2.17%. I'll show you the quick year-to-date, and we are still trying to break out. We have just ever so slightly broken out, but not definitive just yet. And in the meantime, I've been tracking volatility. The VIX was up ever so slightly today. Let's put the two-day view on that as well, but not by very much. And then the bond market. I was watching the 30-year in particular. That's going to come into focus this week as we have about 120 billion plus in auctions from the Treasury here. And that has closed the day at 4.95%. So those are going to be closely watched at 1 p.m. Tuesday, Wednesday, Thursday. And then, of course, Wednesday, we got that big CPI announcement before the market opens. Here is the sector action. Let's dial that up. And we got consumer discretionary in the lead, followed by materials, and then tech. That's XLK, then XLE, which is energy. All four of these outperforming the S&P 500. Everything else in the red there led to the downside by utilities and then financials. And if we take a look inside the Nasdaq 100, mixed board. We got Tesla up 4.5%, and I'll show you, let's take a look at the 3-day, and that's going to show us still down 7% after that huge drop that we saw last Thursday. So haven't quite clawed all that back, but we've been up 2 days in a row there. Apple down 1.21% after some news, after the latest about its plans for the future, its devices, services, etc. Meta also down on the day. And let's close here with the Dow. Dow is looking pretty similar to the Nasdaq in terms of the mix between green and blue. An outlier here, Boeing to the upside in the lower right. That's up about 3.17%, as well as Caterpillar, so two industrials, and for that matter, Boeing and defense stock. Defense has been on fire, defense and aerospace. On that note, I'm going to send it back to you, Josh.
Thank you, Jared. Well, for more on the market action, let's get to U.S. Bank Asset Management Group National Investment Strategist. That would be Tom Hanlon. Tom, it is good to see you. So I'm just looking at the broad gauge here, Tom. S&P 500, you're really just knocking on that February peak here, right on the door there. We were talking to a strategist earlier in the show, Tom, and asked him, and he's constructive on this market. He said, listen, he looks at the S&P 500. He says, we're going to keep just grinding higher here. Is that your take, Tom?
Hey, Josh, great to see you as well. We do have a glass half full perspective. We do think this is an opportunity for both equity and credit markets to do well. But Josh, we think in order to get that sustainable rally through the previous high and into new all-time highs and carry that forward, we have to have resolution on the trade discussions, not just with U.S., China, but U.S., European Union, and other partners. So consumers and businesses have an idea of what to expect in terms of tariff rates and can make the adjustments necessary with their spending plans.
All of that said, even with that uncertainty out there, Tom, do things feel like they are returning to a more sort of normal, for lack of a better term, environment here from that sort of whipsaw headlines of tariffs? Yes, we're still waiting for tariff headlines, but certainly the volatility has alleviated.
You've seen some of the most negative case perhaps come out of the market where you do have the United States and China coming to the table, pausing those tariff rates, in discussions in the UK, as you mentioned. And we also haven't seen a material breakdown in the consumer. They're unhappy with the level of inflation. They're unhappy with the price levels. But again, we saw on Friday's jobs report, you're adding about 140,000 jobs a month. You've got wage gains around 4%, which is in excess of inflation. So they do have spending power. And when you kind of dust off those old COVID indicators like movie theater, box office receipts and airline travel, consumers are still spending and traveling because they have the incomes and the confidence in the job market.
Tom, you say here the most important determination for investors today, ensuring they are in the correct investment posture. What do you mean by that, Tom? How do you define it?
Josh, that post-April 2nd volatility was an important time for people to go back to their financial plan if they had one, or go back to their investment policy statement, revisit that, and make sure that that's still in line with their goals and objectives, and still captures perhaps an idea of what market volatility can look like. We had two really good back-to-back years in 23 and 24. Perhaps people got a little sanguine. We saw the volatility. This just ensures that people have the right risk-reward characteristics, have a plan to get invested, and have a plan to get towards that full allocation of fixed income, equities, real assets, and the appropriate segments.
Tom, what needs to happen for the remainder of the year? And this is, again, similar to what we talked about earlier with the guests. What needs to happen from here to the end of the year to see more momentum in equities and positive returns when the year is all done?
It's the sequencing of events. We got the news about tariffs early on. We're still working through the meat of the House proposal, the budget proposal that's now in the Senate. It's clarity on what tax rates are going to be for personal and corporate income tax. It's clarity on what we're going to see in terms of tariff rates. That allows businesses to make long-term decisions about where to invest, long-term decisions about where to hire. That then allows you to put a multiple on it on S&P 500 and other stock markets. That allows you to have a perspective on what the Fed will do in the second half of the year in terms of interest rates. But if you can have stable rates, stable inflation with a downside bias, that's what you need to kind of carry forward that momentum into the second half of the year in 2026.
So, Tom, you're talking to clients and they ask you, okay, against that backdrop, what are the stock market opportunities? You tell them what?
We tell them have their full allocation of equities, but we do recommend a little bit of a global tilt relative to a U.S.-only allocation. Europe, Japan, those developed market indices, they had very low expectations, very low valuations. That's a good springboard to get a decent return if you get some relief. You've got the European Central Bank lowering interest rates. You don't have the same inflation problem in Europe and Japan that we're working through here. So we think it's more of a global opportunity set with that full allocation both inside and outside the United States.
Tom, thanks a lot. Appreciate it.
Always great to be on. Thank you so much.
Take care. Coming up, trade policy uncertainty, just one of the many layers of worries hanging overhead for the U.S. economy. We'll hear from an expert on the other side as the U.S. and China resume trade talks. More market domination overtime coming up. U.S. trade officials meeting their Chinese counterparts in London to continue trade talks. The trade policy uncertainty, just one of the many layers of worries hanging overhead for the U.S. economy. For more, we're bringing in Princeton University professor Alan Blinder, former Fed vice chair. He also served as a member of President Clinton's Council of Economic Advisors. Alan, it's always great to get your perspective. I know you also recently wrote about more broadly some of the policies of the Trump administration, but I do want to get your take on trade, which of course you've also written about extensively, and sort of where we are in the trade talks and whether we could come out the other side better than when we started. What's your assessment of where we are so far?
I'd give long odds against that. You can pray for it, but the odds are very much against it. Look, what I tell my students every year in teaching them Economics 101 is trade wars have only losers. The little bit of truth in the Donald Trump dictum is that if you're the 800-pound gorilla on the block, you can probably make the other guy a bigger loser than you are. That is, we could lose a little, and many other countries, Canada, Mexico, many, many others, including China, I think, could lose more. You want to call that winning, that's winning. But to me, everybody's losing.
What do you make, Alan, of the basic argument that the Trump administration will put out there, which is, listen, they'll say, we want to reform the global trading system and put American companies on fairer, firmer ground. And when they talk about it, Alan, and I'm interested to get your take on this, they'll simply say, listen, As we sit here in June 2025, the global trading system, as it's engineered, just isn't fair anymore. It doesn't make sense anymore. It doesn't make sense that we impose a 2.5% tariff on auto imports from Europe, and they hit back with a 10% import duty on us. It doesn't make sense that we put up with material non-tariff barriers like China stealing our IP. Do you disagree with that premise? Do you disagree with the tactics? Do you disagree with both, Alan?
I don't disagree with the premise, the way you put it, but it's easy to exaggerate it. I mean, we have a protective tariff against EVs, for example. We have a high tariff on trucks compared to cars. We're not completely innocent. Now, having said that, we're pretty good. We have led the world over decades in bringing tariff barriers down from where they used to be. It's kind of sad to see us leading the world up. And it's even sadder to see us saying, our president saying, one day he says there'll be a 50% tariff on this or that, the next day 25, the next day 75. I mean, who in the world knows what's going on?
What about the effort to sort of reshore certain American manufacturing and other industries, Alan? I mean, we've seen companies, some of them do it on their own regardless. Some of them, of course, do it with the promise of some kind of carrot from the administration. But is there value, and is it realistic to bring some of this manufacturing capacity back?
Look, don't we believe, especially with a Republican-dominated government, in letting the free market decide things like that? I mean, I mostly believe in that. There are some reasons to deviate from that. But a lot of the manufacturing jobs, first of all, weren't very good jobs, and secondly, are never coming back, no matter what we do. And thirdly, the tariffs, much of which fall on inputs that companies use to make things, are going to make things worse for many manufacturing companies in America, not better. It'll make it better for some. Look, the steel industry is happy to have protective tariffs. They've been having that on and off since the 1960s. But as I think almost everybody in America knows by now, there are a hell of a lot more steel using jobs than steel producing jobs. So if you look at the nation, we're not benefiting from that.
Well, but certainly, Alan, listen, we're not going to bring all manufacturing jobs back, but we would like to have a lot. We would like to retain our edge in advanced manufacturing,
sure,
right? And we would certainly, I think, like to reshore as many of those jobs as possible. We'd like to protect American IP. These are goals we have. If we agree on the goals and you disagree on the tactics of Trump, what are the smarter, more effective tactics?
Well, there may be cases where we need to try hard, and maybe that's playing hardball, to negotiate barriers in other countries down. But what's easier for us to do, as for example in the CHIPS Act under the Biden administration, is provide government incentives, subsidies if necessary, to have these critical, let's call them manufacturing, although they're not all manufacturing enterprises in the United States. We don't want to be completely dependent. Look, here's a good example, chips, right? We're not completely, but we're very much dependent on Taiwan for chips. Hopefully that'll be fine. But if China should barricade Taiwan, it's not an impossible thing to think about. We're going to want to have the chips at home. We saw it in COVID that we didn't have enough of all kinds of equipment at home. So for critical equipment, yeah, there is reason to keep it home, even if it's more expensive than importing it.
Alan, I want to turn to more of the subject of that op-ed I mentioned that you recently wrote in the Wall Street Journal. And this is, we talk about trade all the time here. We talk a lot about the markets. We have talked less about the situation with cuts to research at universities. Of course, the sort of battle that has been emerging between Harvard and the administration. But you talk about the economic potential, at least economic impact of those measures. So bring it home for us. What should people be watching for in that situation?
Well, I think one of the ways we've created a lot of comparative advantage for us in high-wage, high-tech industries is through the cooperation of a government, which is often making grants, businesses, which are often coming in after something that used to be experimental becomes economic to produce for a profit, and universities where the scientists are not worried about producing for a profit. They're doing basic research, some of which never will lead to goods that private companies produce for a profit, but some of which will. And the returns on that are tremendous. And the Trump administration is destroying that. It's declared war on the elite universities. It's declared war on research. Every day I read in the papers or online about some other line of research that's been eviscerated or made illegal or defunded or whatever, ruined by government action. And this is not easy to get back. If you just to take one obvious example, if you stop something that's in the a drug development that's in the middle of a trial on human beings or even on animals, and you stop it, you don't just start it again a year later. You're starting from scratch. And so for however long this lasts, we're setting ourselves back. And you might say, for what reason? I don't see a reason.
Well, Alan, the reason the Trump administration gives is that you elite institutions and you, Harvard, have to stop the harassment of Jewish kids on your campus, right? And if you don't do that, if you don't take steps to do that, there will be consequences.
Does anyone on earth actually believe that?
Alan, Harvard's own internal reports show there's an issue.
No, I didn't mean that Harvard had a bad record on anti-Semitism. What I mean is that's what's actually behind the Trump attack.
So what is behind it, Alan? If it's not that, what is it?
I think it's this general attack on elites, that too many of us are Democrats. There was too much wokeness in universities. Look, this is not part of economics, but you do see it in other humanities disciplines and things like that. It doesn't bother me sitting here on the Princeton campus, but it seems to bother President Trump and the MAGA crowd. But I don't see why anybody really believes that taking a stand against anti-Semitism is what's really behind taking a stand against elite universities. And it's not just Harvard.
Well, if it was more broad, Alan, wouldn't he be saying these same things about Princeton then? I don't hear him going after Princeton.
We have not, thank heaven, I don't know how long this lasts, been a primary target of the Trump invective. We have, however, had grants canceled, mostly in the sciences, but also in the humanities, where there are grants. They're small amounts compared to the sciences, but a lot of them have been zeroed out. And, and we're a major target of the so-called endowment income tax because we generate a lot of income from our endowment, which, by the way, we use to keep education cheap with financial aid for students who can't afford it, among other things. So you're right that we haven't been a principal target yet, and we're very happy that we're not. And if we never are, that'll be great. But everyone around here, or not everyone, most people around here are worried about that.
Yeah. I think, Alan, there's Americans who are plenty upset by what they've seen on some of these campuses. But I appreciate your time, as always, to hopping on the show.
You're very welcome.
Time now for What to Watch, Tuesday, June 10th. Starting off on the earnings front, we're going to be getting another round of reports tomorrow from GameStop, J.M. Smucker, and Dave & Buster's. GameStop announced results for the first quarter in the afternoon. The latest report comes as the video game retailer expands in the cryptocurrency market. Company announcing last month that it added more than 4,700 Bitcoin to its balance sheet.
Taking a look at the labor market, the NFIB Small Business Optimism Index coming out in the morning. Economists forecast that number will hold steady at 95.8 for May, suggesting small businesses could be taking a wait-and-see approach amid tariff and policy uncertainty.
And moving over to Apple, day 2 of Apple's Worldwide Developers Conference is taking place in California. At day 1 today, Apple unveiling its new iOS 26 liquid glass interface, the next version of its iPhone operating system. Yahoo Finance will be on the ground in California this week, reporting live from the conference.
That'll do it for today's Market Domination Overtime. Be sure to come back tomorrow at 3 p.m. Eastern for all of your coverage leading up to and after the closing bell.
But don't go anywhere. On the other side of the break, it's Asking for a Trend. I've got you covered for the next half hour with the latest and greatest market moving stories so you can get ahead of the themes affecting your money. Stay tuned.